All right, so we'll give it another minute or two for people to come on. Okay, so good evening. My name, if you don't know me already, is Talia Lerman, and I'm the Chief Program Officer here at JWF. Welcome to Money Mavens. This is our free monthly series of financial literacy workshops for women and girls. This series features women presenters in finance and related fields who guide us on how to take charge of our economic present and future. Thank you to our education program sponsor, Eileen Berman and Jay Bauer. So just some quick housekeeping. You can submit questions into the chat or the Q&A section. I'll be monitoring that tonight. And when we have built-in time afterwards for questions, I've pasted the bio of tonight's moderator and presenters into the chat box. That's a PDF. Before I turn it over to our esteemed panel, I wanted to mention that since we began Money Mavens in November 2021, I've seen the gender wealth gap topic featured more and more in the news. Progress on leveling the playing field, however, between men and women has been slow. According to the US Census Bureau, women still make only 83 cents on the dollar. That's an improvement of just 6 cents from a decade ago. I wanted to reiterate how important this discussion that we're having tonight is, how empowering women with our words, with our knowledge, and with our intentions is very important. So thank you in advance to our speakers and our panel, and thanks to each of you for attending, for taking time today to invest in yourself and learn from women in this field. So without further ado, I'm going to turn it over to tonight's moderator, Suzanne Holmes. Suzanne?
Thank you, Talia, and welcome everybody, and thank you for joining us. I'm joined tonight by two wonderful friends and colleagues from the financial services world, Lauren Stumer, who will tell you a little bit about her background, and Cindy Pollock, who also is, I've known for a long time as well. And part of what we do as financial professionals when we gather together in different organizations really is share, you know, I've always called, when I was working, I called us friendly enemies or friendly competitors, because we are all in a business, clearly. But as women, it's always been important to me not only to look at my female clients with a special affinity, because having been through many of the things that I know they're going through, I want to make sure that they have a literal and figurative seat at the table. All those topics are going to be covered, I think, when we talk about the gender wealth gap and all the different areas that it might cover, not just finances, but psychology and relationships. So, Lauren, how would you define the gender wealth gap, and how would you say it's evidenced to us? So obviously, it's clearly evidenced, but how would you say that it's evidenced to us all?
Yeah, sure. So I think, you know, Talia mentioned, right, I think when most people think of the gender wealth gap, they think of the pay gap, which, as she mentioned, was the 83 cents. I want to make that clear, though, too, that for women of color, that gap is significantly higher on the norm as well. So there's that aspect of it, but then there's also the wealth gap of who controls the wealth of the world. So specific to the US, women control about 30% of the overall wealth today. But one thing I think that's really important to this conversation is that in the next 10 years, given just the age of our population and that more baby boomers will be really coming into their wealth, and the fact that women tend to outlive men by an average 5 years, within the next 10 years, we actually expect that over 50% of US household assets will be controlled by women, or at least have female beneficiaries. So I think that's really important, because the question is, what will those women do with those assets? How should they make best decisions? And then as ourselves in the professional world, how do we make sure that we're setting people up for success? Because another interesting statistic is that over 75% of women who inherit assets, they leave the advisors that they've been with. And I think that, you're asking, how is that evidence? I mean, I think that's a perfect evidence, right? That women tend to be ignored in these situations or feel that they're not heard or are not a part of these conversations with their partners. So there's that side of it. And then back to the gender pay gap. I mean, I think that goes to a lot of the work that we're doing at JWF with economic empowerment and really trying to have real social change. And so I think it's important to at least kind of look at a few things that are being done and talk about, have more of a discussion about how things can get better. Because as Talia mentioned, I mean, it's been slow to say the least. So I think some of that, right, is one thing that a few companies, including I work for Citi, and Citi did this, and I applaud them for doing this, publishing salaries so that everyone in a transparent way can see that a woman of equal education and a man of equal education, if there's a gap there, it's published, it can be addressed. And that's not to say, right, that if a position is published and you're more qualified, whether you're a man or a woman, that you don't deserve to be compensated because you have more experience or more education. But there has to be a fair justification for that. And then another thing, of course, is that in the past, typically whatever you take as a starting salary, which women, as we know, that 82 cents on the dollar, it stays with them their entire careers, because when they're negotiating that next position, they're doing that from the lens of what their current position is. So I think one thing that's really important to note is when you're interviewing for a position, they're not allowed to ask you what you currently make. They can ask you for your salary expectations, but they cannot ask you what you currently make. And I think that's an important distinction, because nothing says that if you start out being underpaid, that should dictate what you're paid for the rest of your career. So I think those are a couple of nuances, and there's so much to this. COVID has exacerbated this to no end, because so many women have left the workplace because they've had to deal with additional stresses at home. Childcare issues were such a huge thing during COVID. And so there's a lot of questions of, I mean, they say literally the setbacks that women endured during COVID, it could take 10 plus years for those to correct themselves, because, and then you have other people, right, that say, well, the pay gap is because you took maternity leave, you work less hours, because when you get that emergency phone call that your kid is sick, you rush home and whatnot. And so you're getting paid for the hours that you work. So I think in those scenarios, it's how do we make sure there's more equality within partnerships of families? I mean, we've all heard more anecdotally, but I feel like most of us have felt this. Like, I remember when I had my second child, my husband took both kids to the grocery store once. And he told me at least 5 people came up to him and were like, oh my God, you're a superhero taking a baby to the grocery store. And it's like, well, how else are you going to get groceries? And I can promise you, when I did it 2 days before that, nobody came up to me and was like, wow, you brought your kids to the grocery store. So, I mean, I think things like that, right? It has to become the norm, that it would be just as normal for a man to rush out when they get that call that their kid is sick as a woman, and nobody gets a gold star. That's called parenting and work-life balance. So I think there's so many, psychology things, right, that need to change in order for this balance, in addition to the cold hard numbers that we're talking about, to really see change.
Yeah, that's a really good point that you just made, Lauren, because I read an article just yesterday relating to the fact that the social change about the gender wealth gap really is a societal change that has to happen in the home. So what advice, or how could we, we were talking about how women change their advisors, but this is also, it's intergenerational. You're talking about young people with children, but this is the same thing with older people, even to elderly women who have not put their foot down, for example, when they're sitting across the table from the financial advisor who completely ignores them, even though the account is in joint name and they have as much equity as their partner, because their name wouldn't be on the account if it wasn't a joint decision to have their accounts titled that way. So how can we help women understand that the most important thing for them to know is that they have agency, and how do we help them create that agency? How have you, in your practice, Cindy, have you used your power as a very powerful female to engender that kind of oomph that it needs to help women over that hump of not feeling that they had agency?
Yeah, I think that, first of all, it's interesting. I just want to say one thing about the gender gap and New York. New York came out with a law that you have to publish salaries offered so that it will be equal now in terms of male or female. So if a salary is being offered, it has to be offered to both. And that's happening in New York. Now, hopefully other states will follow in terms of that. But I think in my practice, when both the husband and wife or partners come into my office, I speak to both of them equally. They're both have equal voices. And when I want to find out what's important to them, it's important to know individually what's important to her and what's important to him. And it is a little bit difficult in, I guess, an elder class group to get the woman to talk. She is usually a little quieter. She won't say as much. She defers to the husband. And I try to gather more information out of her in terms of what's important to her, because it is equally as important as it is to him.
And how would you do that? Do you ever separate them? I've done that before.
You know, it's interesting because he, the man usually is the one to talk first. And then I'll say, let's start with your wife. You know, let's start with her first. You know? And
Yeah, I think there are many ways that we can gingerly, or not even sometimes forcefully, you know, we really, Lauren, you mentioned it before, we have to be psychologists first and foremost.
Yes.
We really have to understand what, not only what's important, but sometimes what might drive a wedge. So we have to walk a fine line, and we can't assume that a woman is going to actually want to do that. But that's where social change comes about again. We have to, if we go back to social change, what we're about in JWF is actually trying to affect social change. So what would you say would be the, well, tell me some of your own experiences that would actually lead to social change. Do you have any recollection of something that you felt was really important to the person that was in front of you, or something that might have changed the direction that they'd been going in?
yes, I do have that. I have two cases where recently where the husband, one was in cash, all cash, and he is risk adverse, but more than risk adverse, he's scared of the market. And he's been cash for 10 years during one of the biggest booms of the century. And his wife said, enough is enough. I want to go to a financial advisor and, you know, do something different finally. So she was proactive, and they came in to see me, and we went along and invested in something different for a change. I had somebody else where he was a trader and in Wall Street, but trading isn't necessarily the way to make long-term quality diversified investment portfolios. So she came in with him, and they are in a long-term quality diversified portfolio. So, and there were two different age groups in both of those people. One was in their late 70s and the other ones are in their early 60s.
Yeah.
So it's a little bit different.
Yeah, and what you just talked about there, though, is a very good point. There are so many things out in the world today, so many investment vehicles. This brings in the investment basics part, because people have almost too much information to absorb, which really is in the beginning when you meet someone or when someone comes in who might not have too much experience. It's very daunting to see all the forms that, first of all the paperwork, all the disclosures. But we have to do it. We need to help people understand that the protections that these kinds of things, obviously it's protection more for financial institutions than it is for the client, but however, it does provide a platform for if there is ever a problem, for the parties to be heard equally, that in and of itself. But how do we approach the investing basics for people who, as you say, a trader may not have any clue about what a well-balanced, diversified, risk-appropriate portfolio looks like for them?
Right.
Believe me, I retired after almost 40 years in the financial services, way too long, really. I should have retired. Like the second time that I retired, not the third time I retired. But the thing that it keeps pulling me back, because even now that I'm retired, people have still come to me. People who, for example, Cindy, the example you just gave, a friend who worked with me, but who had left a 401k lying fallow since 2008 without being invested. And it was just lying there in a cash account, a money market account.
Oh my God. I
helped her, and I won't mention the name because we're not talking about who or what, but let's just suffice it to say it's the largest mutual fund company, a very fine company founded by a man whose initials are JB. Okay. So anyway, and who's been in a little hot water lately. However, those things do happen. It's happened to all of us in all of our companies. Companies, I think, strive to provide good products, but we are the ones who make those products into ways for people to thrive and to protect their assets and to grow their assets and to get income. So we are the filter for all of that. But let's talk about how we approach people. Lauren, give me some examples of what your process is.
Yeah, sure. I mean, I think just like Cindy said, right, when you have two people in front of you, if you have a man and a woman, making sure you're speaking to both of them, and also educating male colleagues. Like, there's nothing to say that a female can't get great advice from a man. Mm-hmm. But I do think, just as most women's empowerment groups, they recognize the power of men as allies. And so I think one thing that we can do as female professionals is make sure that our male colleagues kind of understand some of the nuances, understand some of the potential insecurities, because one thing that we know, right, is that when a man doesn't know what he's talking about, he's really happy to BS it or just nod his head and be like, yep, perfect, let's do that plan. Women are afraid, just typically are more afraid of things they don't know. And the reality is, right, we're not taught these things in school. I mean, most people, unless you took some major econ classes in college, they don't even necessarily know the difference between a bond and a stock. And for reference for this conversation, a stock represents equity or ownership in a company versus, a fixed income or debt investment represents debt or, using leverage on a company where they're paying you back as somebody that owns debt in the company. So I think part of it is encouraging questions, right? Whether it's even you as the advisor posing the question as if you were them, right? And just kind of putting it back to you. And then I also think for women to interviewing an advisor, right, is like interviewing anybody. If you're interviewing a childcare provider or someone to clean your home or anything else in your life that you may be hiring, a handyman, etc. We're very fortunate in this day and age that there's incredible resources online. So if you're a little worried that you don't know what to ask, or you're worried that you won't feel prepared, if you Google like questions to ask a financial advisor, you're going to get a ton of things. And if that gives you some confidence to know that you're asking certain things that maybe are important to you, right? Like, I think a lot of people, and women especially, like, what's my worst case scenario? What's my downside? What's my risk of this? I mean, I think those type of questions are great questions, and you absolutely should understand that, because most people and most advisors, we want to focus on the positive. We want to tell you all the great things about investing, but it's absolutely our job to make sure you understand the risks and the negatives. So I think that would be the biggest thing, encouraging questions. And then on the flip side of that, you're the consumer, like you're interviewing somebody. You have all the power in this case, right? When you're interviewing somebody. So take a few minutes and be a little prepared, and that may give you some confidence to ask the right questions.
Good point. As a matter of fact, one of the things that I've been doing and still do, recommend, I used to buy cases of these books for my clients, because many years ago when I worked for First Union, which became Wachovia, which no longer exists. Well, no, it does as well. Wells Fargo. How did that happen? I used to buy, first of all, there was Wall Street Guide to Understanding Investments. It was a little thin book. And the other one was it was Seas and Crespo, Barron's Guide to Making Investment Decisions. That book is still available. It's been through 8 different iterations, and it's available on Amazon. And the 5 people that I've helped in the last year, I've recommended that book. And you take it in little bites, but that book in particular, and I'll give the link to Talia later to put that in if anyone is interested. That book, I think, is it's a primer. It is something that people who are not, even if you're aware of investment basics, this really digs deep into the setting the stage for what you should be thinking about, and how you can better structure yourself. And it also helps people with the relationship with their advisor. That's why I gave it to them. I wanted them to ask me questions. If you can't ask questions if you don't know what questions to ask. That's the thing that I always thought, that it's, you have, and especially that comes to women who may not have had any experience because their husband or their partner may have controlled the finances. And believe me, many times I've run into women over the course of my career that didn't want to know. I've had more than one occasion husbands who would say, please explain this to my wife. She's never done anything but write a check or give a credit card, and I want her to know, because these are more elderly who they knew they were not going to last as long as she did. And I had one who was so reactive to that. When he dies, he dies. My son will take care of it after that. I said, okay, my job is done here. But anyway, fortunately, they're still going strong. I think they're both in their 90s now. But anyway, that was 25 years ago, so I'm glad they're still around. However, it's important for people to know what questions to ask. And if they don't have a clue, and Lauren, you mentioned a lot of people, we sometimes expect that people are going to know what a stock and a bond or an option. Well, people shouldn't be, who don't know much about investment, shouldn't be thinking about options anyway yet.
Right.
But it's important to know what the terminology is, what these things mean, and what they mean to them. What does a stock do for you? It pays you dividends. What does a bond do for you? It pays you interest. So if you want income, you buy more bonds. If you want to grow your assets, you buy stocks. If you want to have a nice smooth ride down the middle, you make a nice diversified portfolio that is within that doesn't give you heartburn, that lets you sleep at night. These are all the things that we say, but it's so true. To us, it's simple, but it's not necessarily simple to the person on the other side of the table. So how do we do this, Cindy? How do we make that person feel comfortable? How do we help them understand what we're talking about?
Well, first of all, I really go into, I try to give them value, and I try to find out what's most important to them and what is important about money to them. And I want to get information from them and learn about them to see what their goals are. And then we can go into the questions, and I can give them materials from the company which they could learn and read. I ask them questions relating to their risk tolerance, which is very important in terms of deciding where you're going to be with your portfolio and what kind of investing you do. So I think that's an important thing to understand and for them to understand.
What about you, Lauren?
Oh,
Oh,
I wanted to, sorry, I just want to step in for 1 second. One thing that I wanted to follow up on what Lauren was talking about. There was a statistic that I read recently that said that financial literacy is only taught in about 21 out of 50 states. And of those that do, few teach the most critical concepts of personal finance like we're talking about today. So that would be something as basic, and I don't mean to snub it, but something as basic as, like, you know, the difference between stocks and bonds, right?
Mhm.
Then we have a question from Bela. She's asking, is it generally better to avoid investors who make their money whether or not you make money? And I'm thinking that maybe by investors she means like a financial professional or something.
Or a hedge fund?
Yeah. Yeah. So
Mhm.
so is it generally better to avoid, you know, advisors or whomever who make their money whether or not you make your money? Or
Well, I
whether
think
you make-
that sounds like an old broker's joke, an old financial joke. Where are the clients' yachts?
Yeah.
I don't know if you've ever, it's just a simple, it's like a punchline, but everybody knows it's like, yeah, brokers make, whoops, I'm sorry, I got, here, bigger. That there's obviously financial advisors, there's been a lot of bad actors in the world, but there are bad actors in every walk of life. What we were talking about here, you know, is focusing, and Lauren mentioned it, know who you're dealing with. As a matter of fact, and I wrote an article about that years and years ago in the supplement, the Palm Beach County Estate Planning Council supplement in the shiny sheet, probably 10 years ago, about knowing who you're dealing with. And there are so many ways to find that out. First of all is FINRA broker check, because everybody who's a financial advisor, whether they're work for a bank or a brokerage or a financial services firm, are registered. They have to have a Series 7 license, Series 60, a series of licenses. And FINRA, you can just look up FINRA/broker check, something like that. Put their name in, it'll pop up, and you'll see whether they've have been sanctioned, whether they've, you know, had any problems. And you should, and it's really incumbent upon the people. And that was another topic that we were part of this that we wanted to touch on, is the responsibility of the client to do these things, to educate themselves. I'm not saying, you know, go take a master's degree in money, credit, and banking, but knowing what the basics are, but also knowing how the financial services industry works. And I sort of made a joke about the great fund company that was started by a man named J.B. But how much you pay for the service for investing advice is important, because every cent that you invest for yourself is more money down the road, because the most important factor, I think, of investing is time. Time. It's the accumulation of assets over time. And that's another point of the investment basics that we're going to talk about. So let's circle back.
How much time you have.
It depends on, yeah, exactly, it does. However, you got to start sometime. So whenever you start, it's better than the day you leave it uninvested.
Yes.
So let's talk about dollar cost averaging. That's a very important thing, whether it's somebody that starts at 20 or somebody that starts at 40 or 50 even. So who wants to go for that?
I'll talk about that.
Okay.
I mean, dollar cost averaging actually is accumulating assets right? By investing a fixed amount of dollars in securities at set periods of time, intervals, regardless of where the market is, whether it's up or down. So basically, your cost is going to be lower because your dollar cost averaging. You're not just buying it in an up market, you're not just buying it in a low market. And so your overall cost is lower than if you were buying a certain number of shares over set intervals. And it really is a good way to start off. I mean, if you can put in $50 a month and start off with that, $100 a month, it really is worthwhile to do that. It may seem like a little bit, but it accumulates.
It does.
Good.
I think, Suzanne, if we can go back to the question for 1 second, because I think one thing that's important to understand is how financial advisors legally can get paid, right? How you can compensate for services. Because one of them is you can pay a fee on your assets under management, right? So if you invest $100,000, you may be charged a 1% fee, which would be $1,000 a year. And then every time you make a trade, you wouldn't pay an additional fee. You'd pay that set fee for your assets under management. The other way is what we typically refer to as a brokerage model, where you don't pay a fee for the account, but every time, let's say I call you and I say, hey, I really like this stock in the biotech world. Here's the reasons I like it. Here's the risk. And you say, yes, let's buy it. The other way is you could pay a commission, which is each time you do a trade, you pay a fee. The challenge kind of the question, right, is should I invest in something where the advisor only makes money if I make money? It's a tougher model. I mean, that model doesn't totally exist because you're technically paying for the advice, right? And while I would love as an advisor to say that I always have perfect advice and I know exactly where the market's going, none of us can make those claims. So I think a lot of that part is, again, just as Suzanne talked so beautifully about, is you have to know who you're working with, and there has to be a level of trust. And I can make a recommendation to you and it could go down next week, right? But what we both have to be on the same page about is, given the information that I gave you, right? Maybe it's that we think the interest rates are going to go up and that's part of why I'm making a recommendation, or what's going on in Ukraine and Russia, we think oil is going to continue to go up, or whatever the basis of my recommendation is. If a week from now it goes down, but we still believe in the premise, that's a perfect opportunity, like what Cindy's talking about, of a dollar cost averaging scenario of buying it at a lower rate, because the premise that we agreed upon to make the investment, we still believe in. So I think the idea of compensation, it is a tricky one. I think one thing as a consumer too that you should understand is compensation for advisors has majorly come under fire in the last 15 years. And what advisors are allowed to charge and how much scrutiny is given to what they're allowed to charge has gotten much tougher. So as a consumer, theoretically, it's a lot harder to overpay. Hedge funds are kind of their own beast because you're taking on a different set of risks. So you typically pay an upfront fee, and then you also pay a participation fee. So if you're up typically more than a certain threshold, then you also pay a participation fee to the fund for the privilege of being up that amount. So I think it's really important for the basics conversation to understand how advisors can be compensated and what you're paying.
But circling back to the idea of educating oneself, because we've only talked about stocks and bonds. We haven't talked about mutual funds, of which there are tens of thousands, and mutual fund companies, et cetera. That's really, if you're talking.
Oh, we lost Suzanne there for a second.
We lost
Hopefully,
Suzanne.
She'll come back on.
come back
on.
Yeah. Lauren, if you and Cindy could talk a little bit more about some of the investor basics, that there may be things that people don't know, some of the different, like maybe asset classes or some different things that, like, maybe there are questions that come up when you meet with women that are different than when you have a client who's a man. If you can talk about that a little bit.
Even if we want to talk about mutual funds, mutual funds are little companies that invest in hundreds of stocks or bonds or other types of investments. And they could be very helpful for somebody starting out because at least you get a whole basket. Right, Lauren?
Yeah, absolutely. I mean, mutual funds are a great potential option. I mean, I think going even further back, right? I think step one is at least having a small amount to invest. Just like Cindy said, it could either be like a weekly amount or monthly amount that you want to put in, or maybe you have a couple $1,000s that you're ready to start with. Then you have to decide, right, if you want professional advice. And if you do, just like we said, who you're working with would be really important. And I know money for a lot of people is scary to talk about, but like when you find a doctor, right, you typically ask friends and family who they use. So I think referrals from friends and family are really important because people are quick to share bad experiences, which I think is good, right? Because if someone's having a bad experience, and they're also usually pretty happy to share good experiences too. So I think that that's part of it. Keep in mind too, though, like if you're just feeling like you want to get started and you don't feel like you're ready for an advisor, and this is, counterintuitive, right, to what I do for a living. But again, lots of online resources. If you're looking to get started on your own and you're not quite ready to go seek out that financial advice, there's a lot of tools and resources online. But I think the number one thing is just making that decision to get started is so important. And then another thing I don't think a lot of people realize, and Cindy, I'm sure you can speak to this too, for a lot of women and men, right? You may have a company retirement plan, like a 401k. Most company retirement plans provide you with somebody like Cindy or myself as an advisor to the plan. So you have every ability to call that person and say, hey, I have my 401k with XYZ Corporation. I see you're the advisor listed on the plan. Can we talk about this? And typically that can also be a nice entrance if you want to talk about some non-retirement assets too. So I don't know, Cindy, if you want to talk a little bit more about that. So.
Yes, I mean, it's true. I mean, I have a lot of 401k plans and I educate the people that are in the plans, and they come and talk to me about their personal financial status or financial holdings, or just wanting to know what certain things are, because people really are not that educated, in terms of financial literacy. And it's easy to just rely on the financial advisor, but the more you know, the more you will get out of the relationship with your financial account. And I think that's what Lauren was basically saying before in terms of being somebody starting out. Your 401k plan is definitely someplace you can go to get educated.
I'll step in again and just say one thing that what I've seen, there used to be the joke that after you'd retire in previous generations, after you would retire, you'd get a gold watch. Well, the gold watch, the pension, things like that are, pretty rapidly non-existent. And for those of us who are, a little younger, you don't necessarily stay at the same job. So the moving the 401k over to an IRA and things like that, that's a very daunting task if you have no idea how to do any of that.
And it's really easy, Talia.
Right. Yes, as I have found out. Yeah.
Just paperwork again. That's
Right.
that's one of the biggest challenges I think that we have as financial advisors, that we have to basically translate all these documents to our clients, which is off-putting to them. And like a trustee to trustee transfer, that's no big deal. But if you don't understand what that you had a trustee or what the trustee is, then you don't know what that is. And a lot of people wind up paying taxes because they get a check that they shouldn't be getting because they didn't realize what they had to do.
Right. If they get the check their hand.
Yeah, and I'm sorry about, I had for some reason, my computer died. And so
Oh, wow.
anyway, what did I miss?
No, we just were
Well,
talking
you were
about how to
talking-
get started.
Yeah, great.
Yeah. And you were talking about mutual funds. We just. spoke
Yeah, we
with-
were talking about fees, right? And the question is, if you're investing on your own without, which, let us help you. Don't invest on your own if you really don't know anything about it. But the disclosures, you have to just compare like a stock fund, let's say just a general large cap stock fund. And by large cap, I mean large companies, large capitalization. That would be, General Mills, Nabisco, Nestle, large, very large companies. So large cap stock funds. The thousands that there are of the different fund companies, you can pay anywhere from 1.5% to, I don't know, it used to be 8%, believe it or not. They probably have cut that off since I retired, but probably
Yeah.
isn't more than 3 or 4% now. Thank God, because that was disgusting. I mean,
It was criminal.
but when you think
Yeah.
about the fact that the S&P 500 over the course of its entire history returns 10.9%. So if you're paying
Yes.
8% because for somebody to sell you an S&P 500 fund, then you're not making very much money, and that's not a good choice. Those are the kinds of things that people need to know.
Right.
Yeah.
That is the kind of thing.
Well, that's an important point, Suzanne. I think, again, as we're trying to make sure, because again, it's really hard to know what people know and don't know. So another basics concept, right? If somebody says, oh, our fund was up 10% last year, make sure you know to ask, was that net of fees or gross of
right.
fees? And the difference of
Right.
those two things, right, is gross of fees is you didn't pay anything for that service. Net of fees means, let's say that they charged you a 2% management fee and they told you the fund was up 10% gross, then your net of fees return is 8%. It's the gross minus your fees. So again, just kind of understanding the concept of, what your returns actually are, I think is really important.
And 2% is too high.
Yes, yes, that too, but I just.
You only
using
want to
round
be
numbers.
paying 1%, approximately 1.3%, something like that.
And you can negotiate fees.
Mhm.
With financial advisory companies, they have their stated rates, but they can be negotiated.
They can
So
be discounted.
don't be afraid, because as Lauren said before, you are the client, you are the consumer. If you want to buy a pair of shoes, you can go shop here, there, and everywhere, and you can find what you want. And the same with financial services. They have stated fees, just as people have, but there are sales as well. So just make sure
Yes.
that you know that it's a service that you can find out a lot more. Just don't be afraid to ask, and don't feel that because you're not familiar with the terms that, and don't let anybody bamboozle you either by using big terms like exogenic shock or something like that. I mean, that's a fact, but you don't want to be, people should speak plain English to you and be
That's
willing
right.
to explain every single detail that you don't understand, because that's their job. That's our job, to make
And
sure
it's-
you understand what you're doing, to make sure that your best interests are served, that we're working for you, to make sure that you are going to be financially stable and able to live a very comfortable life if you take our advice and start doing dollar cost averaging and stay the course and don't panic. Those are all very important things.
And not to let emotions
Exactly.
a way of investing.
Exactly.
One critical thing, you find out what your risk tolerance is, you find out what your time horizon is, and you go with the flow
Right.
of long-term investing. If your time horizon is long-term, you go according to what your time horizon is. And you do not let your emotions get in the way. I mean, in the last few weeks, there really were times when it was quite emotional. For, you know,
Believe me, in the
Right.
last 40 years, there have been more than a few times. It's so
yeah, no, I
emotional.
know,
Yeah.
I know.
Yeah.
I know
But you know
that.
what? We're still here. You know, the world didn't end. And people
That's
who
right.
did not panic and who stayed the course and were true to their premise, were true to their risk tolerance and were investing accordingly, did just fine.
They did.
Suzanne or Cindy, do one of you want to explain what risk tolerance means and also what we think of when we talk about time horizon?
That's a very good point. And because I was thinking as we were saying it, a lot of people, I remember a lot of times people would say, I would say, well, what are your goals? And the men usually was, I want to make 15%, but I only want bonds. I only want treasuries. And I would just pull out the treasury chart like the 10-year treasury is now paying 1.7%. So how do you think we're going to get there?
Yeah.
So people have to understand really and be honest with themselves. So that in and of itself is a process of trying to get people to accept what their true risk tolerance is and what they then can logically expect. And I'll tell you something, and it's a Madoff story, because unfortunately I had quite a few clients that were burned by Madoff.
Oh,
And the thing that would burn me, I would go to do our quarterly review, performance review, and when my clients would pull out his Madoff, it was a dot matrix printer, and I'm thinking, there's no disclosures on, there's nothing on here. I got 10% when, you know, the market
wasn't
was
that
around
disgusting?
whatever.
I know.
And I say, this is smoke and mirrors. This is smoke and mirrors. I'm telling you, I told them all. And unfortunately, it was just the siren song of, oh, I got 10%. Oh, you know, no. You have, again, it goes all the way back to what was that strike price conversion BS? I mean, they were trying to tell me, it's like, this means nothing. This does not have any meaning, any literal or figurative meaning, strike price conversion. That's what the formula that Madoff was used. So if people try to bamboozle you with language that doesn't make any sense, it's because it doesn't make any sense. So
Because
it has
it's
to
not
make
true.
sense. And your risk tolerance, you have to make sense to yourself. If you're saying that you need 10%, then you need to be willing to take a lot of volatility that the market, as Lauren said, market will go up and it will go down. If you look at any week or any month, you see in that week and month, even though the market's gone up over the past 100 and some years, any given tranche of time, you're going to see volatility. So if you can't take that, if you can't sleep at night, or if it gives you heartburn, you shouldn't be doing it. So our job to our clients is to make sure that they understand where they are, what their risk tolerance really is, and to accept it, and to go with that, because otherwise nobody's going to be happy.
Mm-hmm. And the risk tolerance is your comfort with risk, right? I mean, volatility, your comfort with the volatility in the market. That's right.
And with the fact that things do go down in value. Volatility. If you make a bet on something that's a high flying stock, you know, thinking or hoping that you're going to make a killing, you may in fact make a killing. But it's not a good premise. It's not good investment. It's not good investment procedure. It's gambling, because that's what it is when people don't have a premise, don't understand their own risk tolerance, don't understand what they need for themselves to be able to have a good outcome.
Mm-hmm.
It's really a fine line to walk.
We have another question. It says, if I'm starting with a fairly small amount that I can invest, is it best to immediately go to a retirement account? And this has to do, I think, a little bit with the volatility question. And then use future money towards volatile investments. But I think the basics of the question is like, if someone's starting out with a fairly small amount to invest, do you have some, suggestions in that kind of scenario?
There are a lot of questions that we would have to ask before we could even begin to give information, give an answer to that question. It's, first of all, how old is the person? Secondly, is that money that's taxable or non-taxable? Because if it's taxable, then you would open a brokerage account. You could do it online. If it's a small amount of money, there are lots of brokerage offers out there, Fidelity, TD Ameritrade, Interactive Brokers, tons and tons. And it depends on what that person's definition of small amount is. Because is it $1,000 or is it 10,000 or 100,000? It's all relative to the person.
That also goes back to what you were saying about dollar cost average.
Yeah.
Right. If you were looking to, accumulate, and let's say you weren't particularly risk or you are risk averse, then that might be something.
Yeah. Well, if a person is,
sorry.
Go ahead, Lauren.
I was just going to say, I just want to clarify something because I'm reading the question. So one thing that I want to make sure, and I think these questions are amazing because they go back to, right, they show some of what people know and what they don't know. So one thing I just want to clarify, a retirement account is not necessarily any more conservative than any other type of account.
Right.
All a retirement account means is that it may potentially have tax benefits, but it also could have liquidity risk, meaning that before retirement age, if you put money into certain types of retirement accounts and you take it out before you're 59 and a half years of age, you can actually pay a 10% penalty on what you take out. On the flip side, the benefit part is that if you put money into a tax deferred or tax-free retirement growth account, hopefully, right, you make money every year on your investments, but in accounts where you put money in before you pay tax on that money, you get to pay the tax on it when you take it out in retirement. And the thought there, right, is that you'll make less in retirement than you make while you're working. And so therefore your tax bracket would be less than, versus if you put in after tax money, meaning I already paid the tax to the government on the money I'm putting in. Typically in a retirement account that would grow tax-free, meaning that when I take it out, when I'm retired, I don't have to pay taxes on the amount I'm withdrawing. That being said, within the actual retirement account, the world of investments are open to you. I can put a retirement account in extremely aggressive investments. And oftentimes, especially if you're young, that's what you want to do because you're not going to retire for, 40 plus years, depending on your age. So I think that's something to be careful of. A retirement account does not equal a conservative account, just like a taxable account or a non-retirement account doesn't necessarily equal an aggressive account. It's all the investments that you put within it. But I think, the start to the answer that Suzanne and Cindy were going towards is that for us to really be able to give any concrete advice, our job is to listen and to know what your goals are, what your risks are, what you might need that money for, right? If you told me I've got a small amount of money, but this is for a down payment on a house in a year, that's going to completely change what I can recommend for you versus if you said, I have a small amount of money, I want to put it in retirement because I'm not going to need this money for 30 years. So that time horizon factor that we had mentioned is really important. And what that means is, when do you think you will need the money? Is this money being earmarked for something specific, or is this money long-term growth that you're just, hoping to have for a long time? So I hope that was.
And to circle back just for the informational point, Lauren, what you were talking about, in tax deferred accounts, there are two types. There's the traditional IRA and the Roth IRA. The traditional IRA is tax deferred. You don't pay tax up front until you take it out when you pay tax at your ordinary income rate when you retire. The other is the Roth IRA, where you do pay the tax, but once you start taking it out, it's tax-free. You don't pay any tax.
That's right. That's right. And the other thing is maybe if you're just starting to save, you want an emergency cash account, where you're saving 6 months of your monthly expensive.
Right. If
Yeah.
for a couple, I think it should
For
be
a
a little
couple,
more
it's
for
12
a
months.
single person. Yeah.
Yeah, for a couple, it's more than that, but that is, a lot of times, that's the first place we suggest that people save. And then go to a retirement.
Yeah. Once you have a cushion, it's very important
Once
to
you
have
have
a cushion,
Yes,
especially nowadays. You know,
Mhm.
we've never more so that we realize that nowadays how important being protected is.
that's right.
So where are we? How are we doing for time? I think
We're
we're almost out
doing-
of time.
Yeah, we're doing okay on time. If you could talk a little bit about what you have seen, some of the maybe effects or some of the things that you want to help women avoid when it comes to, avoiding that gender wealth gap, like kind of how to kind of bridge that gap, I guess.
That's a good question. That was something else I wanted to talk about. Not only how to avoid it, but what do we do as financial professionals and as trustees of JFW to encourage and mentor women so that they can be prepared to face it and overcome it. Lauren.
Yeah, I mean, I think starting on the gender pay gap issue, negotiate. Use the websites that we now have available to us. There's things like glassdoor.com and some other websites where you can like Google the name of it, like the title of a position, and you can see what average salaries range for that to make sure that you feel that you're in the range. And I think probably all of us would say, as far as like, what do we see that gives us the most pause, right? At least for me, is when we see women that lose husbands. They don't sometimes even know if they have a mortgage. They don't know what bank accounts they have or don't have. They may never have even met their financial advisor. And, it's already tough enough to lose a spouse, but then to be faced with all these questions. So I just would argue, like, have a plan in place, know your advisors, know where your money is, know who you owe money to. I recommend when I'm sitting down with people that we do at least an annual checkup where we say, has anything changed? Have you taken on any new debt? I mean, because unfortunately, we're still in a day and age where like people will file taxes, and a lot of times like women won't even sign the taxes, right? Their husband signs their name, or they file electronically and click the button that their wife saw it and whatnot. Or, when you apply for a mortgage. Yeah, not smart. No, absolutely. So, I mean, I just would say, like, have an active role, know your advisors. The last session obviously talked about divorce, the one before that talked about estate planning. So also know your, in addition to your financial advisor, know if you have an estate attorney that your family works with, know who your CPA is. Knowing those other professionals, I think, is also really, really important. So that would be my.
And this leads over into another topic, very important that you just mentioned. It's not about the investing part, but the documentation part. If you make sure you have a will, make sure you have healthcare surrogacy, but make sure if you have trusts, if you have a trust that you understand what that trust document says and how it affects you. It's extremely important. I cannot tell you how important it has been to some of my clients who's, just because of badly drawn document, just had them hamstrung for the rest of their lives because they were not named as trustee, even though they were named as co-trustees. They were not given the opportunity by the other trustee to exercise. And so know what these documents mean. And if you don't, take them to someone. I mean, if you don't feel comfortable, or if you feel that you've been left out of the process, then take agency. And that we said that at the beginning. In order to close the gender wealth gap, in order to close the gender gap, of inequality that we talked about beginning in the home. It's important for women to take the agency. We do it all anyway. So we need to understand that we are powerful, that we have the power to do these things for ourselves. And we have places to go to if we don't know the answers to get them. And here we are. Here we are, the three of us, and there are many other financial advisors in JWF as well who are trustees, and we're a great resource. So please use us.
Absolutely. That's right. Absolutely right.
One thing that just sparked me, I saw Denise wrote, designate beneficiaries, such great advice. But one thing to keep in mind that I know I didn't necessarily realize before I was in the business, and certainly as a young mom now, don't designate minors as beneficiaries.
Oh, yeah.
It gets really complicated. They can't actually be owners of those assets. So if you have minors that you want your funds to go to, set up a trust. It's easy. Have an adult beneficiary, or at least a guardianship where you would name, a family member, a close friend, someone that you would trust to
An
manage the
executive,
money
yeah.
for the benefit of that minor.
Yeah.
But I can't tell you how many situations, especially, right, we live in a day and age, there's lots of single parents out there or divorced parents, and God forbid somebody passes away, and then the kids are named as next of kin and beneficiaries, and there is so much court battle that goes into it. You think you're doing the right thing because you've named beneficiaries of your children, but really it turns into then the court needing to appoint. It's expensive, it's time consuming, and you want
And it's public.
and it's public. Yeah.
Yeah.
So just something that I don't know that everybody realizes about designated beneficiaries and having children and wanting to make sure that they're taken care of and whatnot.
Yeah.
That's really important information to hear. I also did not know that. Did not
Yeah,
know
most
that.
people don't realize it because it's counterintuitive, right? You're just like, well, that's my next of kin, that's my kids, I want them to be taken care of. But children, until they're adult age, cannot legally own assets. So like if you left your house to them, for example, that's a perfect example of don't leave your house to your children. It gets really complicated.
Yeah.
So we can wrap up fairly soon. Does anybody have any additional questions? And while they're thinking about those questions, we covered a lot of material here. I feel like we could use this to write a glossary of terms of things.
Absolutely.
So my brain is now.
Talia, I will now send you that link for the book, Barron's Guide to Making Investment Decisions, which is a great glossary. So
Yeah, I actually, while you were talking, I had put that link, that Amazon link. Yeah, Guide to Making Investments. So that's in the chat as well, but I will definitely use that as a resource and put that in when I send the link to this recording, and also a post-event survey. I usually send that out right after this. So I'll put that resource in there as well. And if anything else comes up that you all think about, you can certainly send those to me and I can send those on to attendees. So if no one else has any questions, I think we can wrap up. If you all have any final thoughts for this evening.
I just want to thank everybody for joining us, and I hope that we have answered your questions and provided some clarity around issues that might have been a little fuzzy. And I, for one, am very happy to speak to anyone who'd like to speak to me about any topic. I'm retired, so I have plenty of time.
Yeah, and I would be willing to speak to anybody as well. And thank you again, and take charge of your own financial situation. That's what I have to say.
Yeah, it's like when you go back to, I'm thinking back to school times when they say, no question is a stupid question, because it's only going to help you empower yourself. Yeah, Lauren?
That is so true.
My final thought would just be no amount is too small to start.
That's right.
And it's never too late to start. And the best time to start is right now.
Now.
It's amazing the time value of money. And then lastly, just on a JWF mission note, right, we talk about economic empowerment and financial security for women and girls. And I know, right, this literacy series, we talk about it to make sure we're empowered and educated. It goes to so many other things, and it prevents domestic violence, human trafficking. Like there's so many other
Mhm.
things that being in control of your finances can protect you from. So just know that there's power in that. And,
Yeah.
you know, yeah, really,
Yep.
no amount's too small, and it's never too late to start. So
Yeah. Well, on that wonderful note, Lauren, I'm gonna end it here, but I just want to say on behalf of JWF, thank you for attending. And I mentioned that I'm going to send out the post-event survey and the link to this panel. And thank you so much. And hopefully we'll see everybody back here again for another Money Mavens. Thank you all so much.
Thank
Have a great night.
Yes,
Thank you.
thank
Good
you.
night.
Bye.
Good night.
bye.